My name is David Kuenzi. I am the Managing Director for International Wealth Management at Creative Planning and Thun Financial Advisors. And we are going to be talking about the counterintuitive and vexing issue of currency management and long-term investment strategy in a cross-border environment. We are going to start today by going through an introduction to Thun Financial Advisors and Creative Planning. And then we're going to talk about the goal. The goal of currency management is part of an integrated investment management and financial planning for American expats and cross-border families. We're going to talk about the principles that we need to employ in devising our strategy for currency management within our portfolio and wealth management strategies. And then we're going to talk about how you implement that in a practical sense as an American abroad or as a cross-border family dealing with assets and accounts in different countries, taxed in different jurisdictions, and so on. We're going to go through a lot of examples, and then at the end, which I think will be in about 40 or 45 minutes, we're going to go through a question and answer session. So you can feel free to start typing in your questions at any time. We will get to all of the questions, so don't worry if you're concerned that it's going to get cut off, just put it in there. If you wait, I will get to your question, believe me. And so we're looking forward to a very good discussion after we go through the principles of the presentation. So let's start by discussing more about Thun Financial and Creative Planning for those of you who are not familiar with our firm. Thun Financial is the international advisory group within our parent company, Creative Planning. We provide comprehensive approaches to building long-term wealth customized for the needs of expatriates. Not surprisingly, our client base is very global. We have clients in over 65 countries. Creative Planning and Thun, together we are one, is a U.S. registered investment advisor. We are regulated by the Securities and Exchange Commission in the United States. We are a fiduciary and operate 100% at all times as a fiduciary to our clients wherever they reside, inside the United States or outside the United States. Our firm has been widely recognized, that is, Creative Planning is a top U.S. registered investment advisor and independent financial wealth advisor for many, many years, as you can see here by its top rankings in the Barron's lists and the Financial Times and so forth. Creative Planning comprehensively manages $90 billion of assets for clients all around the world, including in the United States, of course. We have 34 offices in 20 states. We are fiduciary, as I said. We custody through a variety of institutions, TD Ameritrade, Schwab, Pershing, Fidelity. For our international clients, we primarily use Schwab, Pershing, and Fidelity. I'm sure we can talk more about that issue in the question and answer session. All right, this is the Thun team, the international advisory team within Creative Planning that works with our clients residing outside the United States and some of our cross-border families within the United States. It's an extensive team. It has vast experience in the complexities of law, accounting, investing, portfolio management, financial planning, all of the technical aspects and expertises that we need to deliver comprehensive wealth management and outstanding investment results for our clients. But more than just being technically adept, our team has vast experience living the experience that you all understand. What's brought you here today, the complexity, because we are cross-border families ourselves. Almost all of us have lived outside the United States extensively. We're married to non-resident aliens. We have assets in this country and that country. And so we understand it from the point of view of our clients. And I think that gives us an especially unique ability to do a great job for our clients. Our expertise has been widely recognized in all of these leading journals and publications. I myself, David Kuenzi, have been a contributor to the Wall Street Journal Expat for many years, writing on these issues for that very important journal. And we're very proud of that recognition. But let's move on to the substance of today's presentation. I want to start by talking about the goal, right? I set out the goal and I want to talk about it. The goal here is to think about integrating the investment management and financial planning with a strategy for dealing with the currency fluctuations so that we maximize our long-term rate of return on our portfolio investments with an appropriate level of risk, right? I mean, very simple. We're trying to build our wealth as well and as effectively as we can while mitigating risk. And one of those risks, we can talk about different types of risks in the portfolio, but clearly one of those risks is currency risk. All right, so our goal with respect to portfolio management and currency risk is to make sure that over the long run, as we build our wealth and manage our portfolios, that we don't find ourselves in a situation where, despite very good portfolio management in other respects, changing long-term currency values have a negative impact ultimately on our accumulation of wealth and our ability to meet our long-term financial goals, which may be denominated in multiple currencies. We may live in the Eurozone and we have to pay for our expenses in euros, or in Japan and we have to pay for our expenses in yen. And so we have to factor that in, not only with respect to the portfolio management, but making sure that portfolio is correctly denominated to provide for the currency in which we're going to have to spend it down in retirement and for other long-term financial goals. Okay, and the first principle I want to talk about in terms of how we do that, the functional process by which we achieve this well-managed currency within our portfolio objectives, is to recognize that we have to make sure that we match the underlying currency exposures that we find in our assets and our liabilities, right? We want to make sure that the currency exposures are still broadly diversified, because we need to have a wide range of currency exposures and different types of securities portfolio exposures. But when it comes to the currency element within that portfolio, we want to make sure that we are building wealth in a way that's going to be correlated with the currency in which we're going to have to pay for expenses eventually, even as we diversify. And so how do we do that? Well, we think about our assets. What are our assets? When I say matching our assets and our liabilities, what do we mean by our assets? Well, these are all the things, all the wealth that we're accumulating during our lifetimes, our savings, our investments, our pensions, our retirement accounts, our real estate. These are all of our life assets that we're eventually going to be using to draw down and fund our long-term financial goals. What are those? Well, buying a house, sending our kids to college, paying for our own retirement, leaving a legacy for our children. These are all our liabilities, the things that we're ultimately going to spend our money on, that we're saving for now and that we're accumulating assets for. And we want to make sure that if our liabilities are denominated in yen or Australian dollars, for example, that the assets that we are accumulating also have a currency denomination or are allocated in a way that it's going to vary proportionally to the potential changing values of those currencies in which we're going to have to pay for these long-term liabilities. Okay, so how do we do this? How is the practice of currency management within an optimal portfolio strategy? All right, I'm going to start by talking about the practice of where we build the portfolios and how we do it functionally, especially for US citizens. I'm going to walk through the issue of lower costs, the liquidity and access, compliance, reporting, and taxes. And the outcome we'll find is that, especially for US citizens, the place to do this, the obvious overwhelming logic is to do this through US accounts using US investment instruments. And as I'll point out, that's not to say US stocks and bonds only, right? But using US instruments to build a multi-currency global portfolio, as we'll explain as we go through this. So let's talk through some of the mechanics of this, costs, right? Okay, we don't have to spend a lot of time on this. Most of you, having been out there in the financial world outside the United States, recognize that the cost for all of these services, whether it's mutual fund fees, as is shown here, or transaction costs, or taxes, or VAT, or custody fees, all of these services are provided at a much lower expense in the United States than they are globally. And you can see that here just in this study from Morningstar, which looked at global mutual fund fees. And you can see down here the US, in terms of the average fees, is not only low, it's a way outlier on the inexpensive side compared to any other country in the world where you might imagine getting these services provided. Okay, what about investment access and liquidity? Aside from having low fees, through US accounts, we're able to invest in virtually any kind of investment, any kind of fund, any kind of stock, anywhere in the world. New York Stock Exchange is home to listings for stocks from around the world, even if they're listed in another country primarily. They have a secondary listing in New York. We can buy ETFs that duplicate the performance of any national stock market or any global bond market or any asset class that we might want to. And we can do this through New York with US accounts, but develop a very global multi-currency portfolio. And I'm going to walk through a couple of examples where I talk about doing this with a European stock portfolio, how we can build a European stock portfolio that gives us exposure to the euro and to European stock markets very, very effectively, but doing it through US ETFs that are optimal from the point of view of access, liquidity, and taxation, as we've talked about before. And I'm going to start by going through one example and then another example. In the first example, I'm going to compare two ETFs, okay? Exchange traded funds, if you're not familiar with that term, they're just baskets of stocks in this case that match an index, in this case, a European index called the Euro Stoxx 50. And in London, we can buy EUE, which is an iShares fund that tracks the Euro Stoxx 50 index of 50 leading European stocks. In New York, we can buy an ETF that tracks the same index. It buys all of the same underlying stocks and trades in Europe. The one in London, of course, trades in London. EUE, FEZ is the ticker in New York. It's listed on the New York Stock Exchange. EUE, although it's traded in London, actually trades in euros. FEZ trades in New York and trades in dollars. Okay, so those are the basic mechanics of these two comparable funds. In every way, very similar, except that if you're buying EUE, you have to provide for payment in euros, and FEZ, you have to provide for payment in dollars. Well, how does that affect the outcomes? Well, EUE actually has higher fees, slightly higher, although they're both inexpensive as ETFs are, 35 basis points for EUE, 29 for FEZ. The trading volume, interestingly, for the European listed Europe stock portfolio, the trading volume on a daily basis is far lower than the same fund trades in New York. And you can see that here, $5 million a day compared to $90 million a day. But the problem and the big point of this demonstration is that if we were to buy EUE, which in almost most respects is very similar, almost the same to FEZ, certainly the investment outcome is the same. But if we buy EUE, we have bought a PFIC, a passive foreign investment company. And as we've discussed in many of our presentations before, a passive foreign investment company for a US taxable person is a complete US tax toxic outcome that you want to avoid, because the US penalizes very heavily from a tax point of view US taxable persons who invest in non-US listed mutual funds and ETFs. So while these two funds the underlying investments are the same, EUE is a terrible tax outcome for any American. Now, FEZ, listed in New York, is of course not a passive foreign investment company. All right, let's look at another couple of examples here. I want to again return to this comparison of a European stock portfolio being traded in New York versus a European stock portfolio being traded in London or in this case in Frankfurt, and I want to compare them from the point of view of investment outcomes now. So let's look on the left side. We've got VGEU, which is a Vanguard portfolio of European stocks. Well, guess what? Vanguard has a huge pool of European stocks that they manage, but they list it in many different places. In Europe, you can buy the Vanguard VGEU fund through Frankfurt, and you pay for it in euros, but you can buy the exact same fund in New York. Its ticker there is called VGK, and its only difference is that it is going to be traded in dollars in New York and euros in Frankfurt. So they both track the FTSE Developed Europe Index, so they have all the same underlying investments. As I said, VGEU trades in euros, VGK trades in dollars. Now let's talk about the returns, okay? Because this is the part that vexes so many people. They're thinking, well, yes, but if I buy the VGEU version in euros, I'm going to get a euro rate of return, whereas in New York, I'm going to get a dollar rate of return. Well, let's examine that proposition and see if that's really correct. So what we did is we went and we looked at the performance in just one year, right? A very defined period, 2015, and we said, what was the return for this fund in 2015 in Europe? Well, the one that traded in euros in Frankfurt gained 8.9% during the year 2015. The one in New York, VGK, in 2015 had a negative 1.8% return. And there you're going to say, of course, they had a different rate of return because the one in Europe was traded in euros, and that's exactly why I don't want to send my money to New York and buy these funds in New York, because look at, I got a 9% rate of return almost in Europe, whereas I would have gotten a negative 1.8% rate of return if I had bought the US version. Well, is that really the case? No, it's not, because remember, during 2015, the euro lost 10.7% of its value against the dollar, right? Meanwhile, of course, the dollar gained 10.7% against the euro. So when you factor in the fact that the currencies had a rate of return, themselves had big changes in values, the outcome for the investor was, in fact, absolutely equivalent. You could have bought VGEU in Europe, right? And you would have gotten a 9% rate of return, but in diminished value euros, or you could have bought VGK in Europe and you wouldn't have had such a great year measured in dollars, but measuring it in dollars, you would be measuring it in a currency that was much stronger. The outcome was absolutely equivalent in terms of the real value to you. Okay, let's take another year. Let's take 2019, because 2019 is a more interesting year where the rates of return were very similar. All right, but they were a little bit different. Why were they a little bit different? So in 2019, the European version generated a 26.5% rate of return measured in euros, while the US version generated a 24.3% rate of return measured in dollars. So now, again, we see that the euro version has outperformed, but now very slightly. Why did it outperform very slightly? Well, aren't they the same fund? Shouldn't they have the exact same outcome? Well, no, because in the euro version, you're measuring the performance in euros, and the euro lost 2.2% of its value against the dollar during that period, 2019, and that is exactly the difference between the difference in the performance measured in their two respective currencies. Again, you had the exact equal investment outcome and the rate of return, whether you had bought it in Europe, in euros, or dollars in the United States in both years. And this is true for any year you may choose or any period of time you may choose. And it has to be that way because, of course, the underlying investments, all of the individual stocks that this fund holds are all exactly the same. In fact, it is just one big fund. Vanguard lists the same fund in Frankfurt and Dublin and Hong Kong and many other places around the world, and you can buy a share of it in dollars, or you can buy a share of it in euros, or you can buy a share of it in Hong Kong dollars. And it doesn't change in value simply because you paid for it in dollars or euros or British pounds or whatever the currency may be. But of course, in the end of the day, right, we have to remember that if you buy VGEU, the European listed one, you've created a huge US tax problem for yourself, which is, again, brings us back to this point that we can build the global multi-currency diversified portfolios we want through instruments available to us in New York on the New York Stock Exchange that don't create huge US tax problems for us as US taxable investors. All right. I'm going to take the exact same example now of VEUR and VGK. This is the Vanguard ETF, the one that trades in both Frankfurt and New York. And I'm just going to show the exact same numbers from the previous slide, but I'm going to do it graphically because I think sometimes this helps us understand and imagine this problem a little bit better. So the blue line here is showing, in this case, VEUR, which is the European Vanguard Europe Fund, tracked from its performance in its version that trades in Frankfurt. That's VEUR, and it gained, as we saw, 8.9%. And here we're tracking the same fund, but the version of it that trades in New York, VGK, trading in dollars. Aha, there we see it again. It looks like the European version did a lot better, gained 8.9% versus negative 1.8%. But again, the gap right here, the gap in the performance, guess what? It's exactly offset by the relative change in the value of the currencies, right? So again, your outcome in terms of investment results is absolutely the same, right? You can measure it in dollars and say, I got a negative 1.8% rate of return, but that's exactly the same as saying I got an 8.9% rate of return in euros in a year in which the euro lost 10% of its value against the dollar. So we can see that these underlying investments are absolutely equivalent, and it didn't matter what currency you paid for the investment. What you have to focus on is what's in the underlying investments. Here we have a portfolio of European stocks. Do we want to have that? Is that a good investment? Well, that's a separate issue, but what we pay for that or how we pay for it, what currency, is completely irrelevant to the issue of portfolio management. All right, now we've talked about the mechanics of buying these, and we've talked about the rates of return. Now let's just focus in on this tax and compliance issue. When we buy the non-US versions of these funds, right, the ones that are not traded in New York, when we buy the European listed version of a Europe fund, or even the European listed version of an Asia fund or an emerging market funds, we're buying passive foreign investment companies. And we have a whole presentation on why we as US taxable persons have to avoid passive foreign investment companies, because they have very, very punitive tax outcomes for Americans. They're taxed at a very high rate. They're very complex to report, and this is probably the single biggest mistake that we see Americans abroad making in terms of their investment strategies. And a lot of times they don't recognize it for many years, and it comes back to haunt them in a different way. And furthermore, we also have to recognize that if we're buying the non-US version of these pooled investments, these ETFs or mutual funds, you could say the same thing about mutual funds, then we have all this additional complex reporting on our US tax return, the FBAR report, the FATCA Form 8938. If we're holding these through non-qualified pensions in countries that don't have treaties with the United States, they can be treated as foreign trusts. And so all of these reporting and tax complications are, again, another reason that, whether we like it or not, the principle of US citizenship-based taxation forces us to move to the US to buy and build these multi-currency portfolios, which I'm very sympathetic to how unfair that feels to us, that the US government has this unique and punitive system of citizenship-based taxation. But as I always like to remind people, ultimately the silver lining here is that if it forces you to move your money back to the US, you're probably in the long run going to have much better investment outcomes in any case, because of the issues we started talking about: lower fees, higher liquidity, and so on and so forth, and more access to investment. So while we don't like the citizenship-based taxation principle in general, nevertheless, we have a great alternative in terms of being able to build the kind of multi-currency portfolios that we want right in the United States. Now I'm going to talk through another couple of currency principles here, because, you know, a lot of people think that a currency presentation is going to be all about sitting up and talking about, well, I think the dollar is going to be weakening as the Federal Reserve keeps interest rates too low and debases the currency with excessive money printing, and therefore we should be buying non-US dollar assets. That is not our analysis at all, right? We're focused on having the right currency exposures, as I said, matching assets and liabilities. We don't sit around and speculate on what we think the dollar is going to do next year versus the euro or the yen or anything else. But what we do is we have to understand the mechanics of having various types of investments in our portfolio where we are taxable in multiple jurisdictions, and we have to report in multiple currencies. And this becomes a very real life issue of tracking our portfolios and the data for proper tax reporting. And what do I mean by this? Well, I'm going to give you an example here, looking at a scenario where you have a big divergence in the relative value of the two currencies in which you have to report, because all Americans ultimately have to report back in the US, right, on their US tax return, and they have to report their investment outcomes in dollars. So if we're looking at a period, and what we do is we take an example here, 2013 to the end of 2016, this 3-year period, and what we've got here is that we've got a graph of the dollar versus the euro and the pound. And what you can see here is the pound over this 3-year period, as you're probably familiar with, lost almost a third of its value. The euro lost about almost as much, about 28% of its value. So this was a period in which the dollar was very strong, and most other major currencies were very weak against the dollar. And this trend has pretty much continued up through more recent years as well. So we're all familiar with that idea, this era of very strong dollar. Well, how does that affect portfolio management decisions, aside from thinking through how we need to diversify the currencies within our portfolio? Well, it has a huge impact on reporting and functional tax planning within our portfolio. What do I mean by that? Well, here I'm going to take an example of a purchase of a share of IBM, and I'm going to use a single stock, not a fund this time, because I think thinking about it in terms of a single stock is oftentimes easier. And imagine we bought a share of IBM at the start of that same period, 2013, and we measured its performance over the subsequent 3 years. Remember, this is the era of strong dollar, weak euro, weak pound. And at the end of that 3-year period, our investment in IBM, well, it wasn't such a great period for IBM shares. After 3 years, you're down 5%. Okay, and your U.S. investment advisor calls up and says, hey, let's sell that U.S. stock, take the loss so we can offset gains elsewhere in our portfolio. That's classic tax loss selling. It's a good practice. We recommend it for all of our clients, and we do it for our clients. But guess what? The analysis doesn't end there, right? Because that loss, that negative 5.2% loss, is a measurement of the gain or the loss in dollars. But if over the same period, right, the euro and the pound both had massive losses against the dollar, when you go back and judge the performance of the IBM investment over that 3-year period and measure the rate of return in euros and pounds, it wasn't a loss at all. They had nice returns, right? In euro terms, it gained 21%. In pound terms, it gained 25%. And if you went and sold it thinking that you're going to save yourself on taxes because you're going to take this tax loss sale, well, you didn't save yourself any money at all if you're in the UK or in the Eurozone, because all you did now is create a tax liability that you didn't have before, because you realized again that you're going to have to report and pay taxes on in Germany or the UK or wherever you are. All right, so this failure to recognize the implications of changing portfolio values in the way we functionally manage the portfolio, especially for tax purposes, has huge negative potential outcomes, especially when you're dealing with advisors and firms that do not understand and do not track this principle. But we do. We are always tracking our clients' portfolios in the 2 currencies. They're U.S., of course, because most of them are U.S. citizens and pay in U.S. dollars in the U.S., but also in their country of residence and the currency that prevails there, so that we can make these decisions about tax loss selling that are accurate, not simply U.S. centric. All right, so let's go through a couple more examples. And I'm going to set this up kind of as a question and answer, because we're starting to get the picture, but going through more examples helps us really cement this idea of understanding that we don't need to focus in on the denomination, the currency denomination of the investment. We need to focus in on the underlying investments and their true performance. Okay, so a lot of people will say, okay, I kind of get it, but if I buy a foreign listed security, if I buy a foreign security listed in the US in dollars, don't I get the US dollar rate of return again? So it's like, if I buy the European stock fund that's buying European stocks, but I'm in New York and I pay for it in dollars, don't I have a dollar investment? Don't I get the dollar rate of return? If I buy a European stock that simply trades in New York, am I getting the dollar version of that share of GlaxoSmithKline or British Petroleum or Siemens? Because that's not what I want. I need the European version, right? Again, I'm going to walk through an example here to underscore this principle that what matters is the value of the underlying asset, not the currency in which you're measuring its performance or in which you paid for it. And taking GlaxoSmithKline, which is a big UK pharmaceutical company, I'm going to demonstrate that same principle in a similar way that I did before, but walking through it this way again with a single stock. In this case, you can buy GlaxoSmithKline, big global pharmaceutical company. Its shares trade in New York, and you can see here in blue a graph of the share price of GlaxoSmithKline in New York. You can see it had a nice return over this period of about 16.6%. This is over the period of 4 years from 2008 to 2012. In London, where it has its primary listing because it's a British company, it had only a 3.9% rate of return. You can see its graph there in orange didn't quite do as well. And you're thinking, aha, well, maybe I should have bought those shares in New York because I did much better, right? Well, no, you didn't. You didn't do any better. You didn't do any worse. You bought a share of GlaxoSmithKline, right? It doesn't sell for one price in New York and perform differently in New York than it does in London. It is the exact same thing. You own one share of the company, and that value is intrinsically the same, whether you want to show its value in dollars or euros or pounds or yen or anything. And why then is the divergence in the performance? Because in the first case, in New York, you're measuring its performance in dollars. And in the second case, you're measuring it in British pounds. But over the period that we're looking at its rates of return, the pound in this case actually gained against the dollar. It gained 12%. Right? So while you only got a 4% approximate rate of return in British pounds, that's no different than getting a 16% rate of return in dollars, because the pounds are worth more at the end of that period than the dollars are that you convert. And if you convert them back, they're exactly equivalent, right? So we need to remember this, that what matters here is that you own a share of GlaxoSmithKline, right? It doesn't matter whether you bought it in New York and paid for it in dollars, or if you've been seeing its value increase or decrease measured in dollars. You have to go back and adjust to compare the two so that you're looking at them in the same currency. And you can look at them in dollars or pounds. Their value is going to be absolutely equivalent no matter where you bought it. Okay, now I'm going to walk through an even more elaborate scenario here. And I take this from the period, what we call the post-Brexit investment decision. Why do we use this period? Because this was a big traumatic event, if you recall, going back to 2016, when the vote happened and there was a sudden drop in the value of the euro very dramatically within a few days. And a lot of clients we were speaking to in the UK at that time were saying, okay, well, that's it. You know, the pound has lost so much of its value against the dollars. I'm absolutely not going to take my pounds, convert them to dollars to buy ETFs or funds or securities on the New York Stock Exchange. I'm just going to buy the same investments here in London, right? Because I want to have my portfolio denominated in British pounds because the pound is very weak. And I think it's going to rebound, and so I want to make sure that I've got my portfolio denominated in British pounds. Well, in this more elaborate demonstration, while that is seemingly very intuitively logical, I'm going to show you why that is not a correct analysis of how investment works. Because we're going to look at what happened if you had made an investment in an equivalent set of securities, one set in London, one set in New York, and held them now over the next year or so, a year and a half or so. And guess what? The pound did rebound. So the pound did have a significant gain in the next year and a half against the dollar, because we're looking at the period June 16th to January 18th, a year and a half. The pound did rebound quite significantly during that period. Does that mean you were better off leaving your money invested through the year the UK funds that were traded and denominated in British pounds versus buying the same ones in New York? Well, let's look, okay? So if you had bought on June 30th, right after the pound crashed after Brexit, 100,000 pounds worth of, in blue, we've got UK stocks. So we're going to build a portfolio here of UK stocks and US stocks, right? And you had bought another 100,000 pounds of US stocks. These are actual funds. You can see them down there. Well, one is the iShares UK stock ETF traded in London. The other one is the US stock fund, but it trades in London in pounds. And you bought 100,000 pounds of each, so you've got a $200,000 investment in US and UK stocks, but you did it in London, denominated in British pounds. And at the end of this period, you have a 26% rate of return between those two funds cumulatively. Not bad. Your investment, which started off at 200,000 pounds, is now worth 252,000 pounds. Okay, well, what if you instead had followed basically our advice, right? Which would have been, don't buy the European versions or the UK versions, because those are PFICs. Those are going to be a tax disaster for you in the US if you're US taxable. Rather, take the money, convert it to dollars, because we have to have dollars to buy the funds that we're going to buy for you. Okay, so you would have converted it at this exchange rate, very weak number for the British pound, 132, but you would have had $265,000 now to invest, and you could have bought the exact same two funds, but except instead of buying the ones in London, you buy the ones, the Vanguard funds and the iShare funds that trade equivalently in New York, and now you buy $265,000 worth of these two funds, and at the end of the period, you have $354,000. You have a 34% rate of return. You're saying, aha, well, I guess Thun Financial was right, because I got a 34% rate of return, and if I had just bought the UK funds, I only would have gotten a 26% rate of return over the same period. Well, we were right in telling you should do this for tax reasons, but in terms of the investment outcome, the whole point is it was exactly equivalent, because you were buying the exact same underlying investments. And if you factor in the fact that the British pound went from 132 to 141 over that period, right? The 252 pounds that you're left with in the UK portfolio is exactly equivalent to the $354,000 you have in the US portfolio. It didn't make a difference in terms of investment return where you bought these two securities, London or New York. The outcome was exactly the same. You can take a 34% rate of return in dollars, but the dollar's worth less because the pound was gaining over this period, or you can take a 26% rate of return in British pounds in a period in which the British pound was stronger. The outcome, the net value, these two numbers, what you're left with, are equivalent, because on this date, 252,000 pounds equaled $354,000. Okay, the reason to do this was not because you thought you were going to get a better outcome by buying in New York or London in terms of your investment results. You did it in New York because you're a US taxable person and you want to buy these investments with US tax compliant investments. And by the way, those funds, VGK, the ones that we're talking about here are also compliant as reporting funds in the UK, which we would always make sure that we were buying for our UK clients. Okay, so you're starting to get the idea here, and we're gonna finish up with just a couple more examples, and then we're gonna open it up to questions. So what we're trying to do then, you're starting to get the idea, right? We want to make sure when we talk about matching assets and liabilities, we can do this through investments in New York. If you're going to be in the Eurozone, right, for example, the kind of portfolio that we want to build is going to be more heavily weighted in Euro assets, because we want to make sure that the performance of that portfolio is more highly correlated to the cost of living when you have to pay for investments in euros. So we can do that, as we said, in New York, but we're going to do that by buying more European stock funds, more European small cap funds, more European bond funds, and more European REIT funds than we might have, or we would have, if you were back living in the US. Now, even for a European investor or a Japanese investor or an Australian investor, if you're working with us, you're still going to get a lot of your portfolio invested in US dollar assets. Why? Because our first principle of investing is good global diversification. And since the US is such a huge piece of the global investment pie, right, you can't have a multi-currency, well-diversified portfolio, right, without having a large allocation to US stocks and bonds. But you're going to have relatively less if you have to ultimately pay, because you're going to pay for your expenses in Australia. You're going to have less. We're going to give you more Australian assets, more non-US assets, because we don't want to link all of your investment outcomes to the underlying performance of the US stock and bond markets. We want to have more international, more Australian. If you're in the Eurozone, more Euro. The Euro is the example we're using here. You still get a lot of US, but you get relatively less. That's proper matching of assets and liabilities within the context of a well-designed portfolio strategy. All right, let's just finish up here by talking through a couple broad principles of currency management, right? Again, as I said, when we talk about currencies and portfolio management, we're not sitting around speculating about what's going to happen to the euro versus the dollar or the yen. And the key point here is, as a lot of times I'll hear people say, they'll say, I have all my money in pounds or Australian dollars, and I don't want to invest in dollars now while the dollar is so strong and my pounds or Australian dollars are weak. Yes, that's understandable. That's why we need to make sure that we're diversifying. We're getting a lot of British pound exposure through the British stock market or the British bond market or the Australian dollar, okay? But we can do that with investments that are listed in New York, as that we've been describing. They may be listed and trade in dollars, but their rate of return is going to be linked to those other currencies, as we've tried to demonstrate, okay? And what we're talking about here, this is not a choice of dollars or yens or euros or pounds, because when we talk about currency, right, we're talking about cash, right? Stocks don't have a currency denomination, as we saw with the example of GlaxoSmithKline. A share of GlaxoSmithKline is a share of GlaxoSmithKline. It doesn't matter if you paid for it in dollars or euros. It's the same outcome wherever you bought it, right? When people focus on currency, they get into the game of saying, what currency is going to be strong? Oh, I think the euro is going to be strong, so I need to keep my money in euros. Or I think the dollar is going to be the best currency for the next 20 years, just like it was for the last 10 years. So I want to keep all my money in dollars. But the fact is, if we're thinking in those terms, we're thinking about currencies and we're thinking about cash, right? Because only cash and some types of bonds have a real currency denomination, right? And when we start thinking about our investments in terms of their currency denomination, we are in a losing less than zero world, because all currencies lose value in real terms over time, right? And you can see this on this slide, right? This just looks at the rate of return over a 20-year period of a whole variety of assets, REITs, which are pools of real estate investments, stocks, international stocks, bonds, gold. And look at all of these lines. They're all quite positive. These are inflation-adjusted rates of return, by the way. Here's cash down there in blue, cash. It doesn't matter if that cash is euros, doesn't matter if it's yen, doesn't mean it's Swiss franc, even the Swiss franc, the US dollar. All of those investments are terrible investments. They lose value in real term, in inflation-adjusted terms. It doesn't matter if you're buying the Swiss franc or the Venezuelan bolivar, okay? One of them is going to lose value faster than the other one, right? But they all lose value. They are all paper currencies, and they lose value at the rate by which central banks around the world print more and more money. That's why you have to stop thinking in terms of currency and thinking in terms of stocks and bonds and gold and real estate. These are the assets that are going to appreciate, measured in any currency, right? You can take any one of these assets and you can show its performance in dollars or Swiss franc and yen, and they're all going to be positive. They're all going to be good long-term investments. But if you're thinking in currencies, you're thinking about the kroner versus the dollar versus the euro versus the yen versus the Australian dollars. All of them will lose money in the medium and long term. They will all lose value relative to inflation. They're all terrible investments. So let's stop thinking about investing in terms of currencies, because that will have terrible outcomes for us in the long run. Some people may say, okay, well, that makes sense, but you know, if I have to send my money back to the New York, convert it into dollars to build out this multi-currency portfolio I recommend, I'm going to lose a lot of money in the conversion, and then I got to convert it back. Well, if you think about it, if you're accumulating assets in, say, Australian dollars, and you periodically have to return them to the US to invest in US dollars, yes, you have to convert it. But if you do that well, as we do it for our clients, that cost of conversion should be very, very low. We typically get it now down at about 1/3 of 1%. And it's only, you know, you should only have to do it one time. Return it to the US to invest it, return it back maybe 20, 30 years later in your retirement back in Australia or in Japan or wherever you happen to be, right? So this is a one-time relatively small cost. Those costs for the currency conversion, it's a one-time lifetime round trip typically, right? That cost is going to be far less than just the typical incremental cost in 1 year of paying all the high fees and the VAT and the custody fees and all the other expenses that you're going to have to invest in your local currency, besides all the negative tax outcomes. So I don't think that is if managed properly, that is not a serious concern. Now, a lot of people say, okay, well, you're talking about, you know, I have to match my assets and liabilities. So, well, my liabilities are out 20, 30, 40, 50 years out in some cases. I don't know where I'm going to be. I don't know if I'm going to be in the Eurozone or in Australia or in Japan or in Russia. And so how do I build that multi-currency portfolio, right? I don't know where my kids are going to go to college. I don't know what currency I'm going to have to pay for their tuition in. Well, good point. This is very typical of our clientele. And in those cases, then, what we do in terms of the portfolio management is we hedge ourselves. we make sure that the portfolio has all kinds of underlying currency exposures so that we don't lock ourselves into any particular region's of economic outcome simply because it happened to end up being a period of very weak dollars over the next 10 years. And I was intending to send my kids to the university in say Canada or the UK, but now I can't afford it because I was investing and saving in US dollars, and now the US dollar has lost a lot of its value, right? So we want to make sure that we've got a lot of global exposures for our clients in circumstances like that, so they're not locked in or out of any particular investment. All right, and so bonds, it's another story. I'm not going to get into that right now because I want to close it up here and get to everybody's questions, but I'm going to just conclude by making these points. Managing currency risk is a key component of long-term investment planning, especially for expats, right? Expats are highly conscious of this environment where they're living and paying for expenses in one currency, but accumulating their assets perhaps measured in another currency, right? We need to manage this effectively. We need to mitigate the risk that currency, we're going to be on the long side of the global geographic currency trade, and make sure that our investments are truly globally multi-currency denominated, right? And that's not determined by where they trade. It's determined by what are the underlying investments. And then ultimately for tax, cost, and compliance efficiency purposes, Americans want to build these multi-currency portfolios through US instruments, through US accounts, as we do for our clients at Thun Financial. Now, on that last point, I will say when we have non-US taxable persons, we oftentimes do use non-US funds for tax compliance purposes. So that's something maybe we can talk about in the question and answer session. Okay, so that's the presentation on currency management. I just want to remind everybody before we get to the question and answer session that on September 14th, just about a month, my colleagues Kathleen Kaffer and Jake Mongler are going to be presenting on IRAs and Roth IRAs for Americans abroad. A great presentation. I hope you'll be able to be there for that. And now I'm going to turn over to the questions. We've got a lot of questions. That's great. We love questions, and I'm going to be getting through all of them. And the first one comes from Chris. Chris says, I'm an American living in the UK and married to a UK citizen, but transferring money into the US Schwab account regularly, thanks to your advice, just starting out and working towards emerging wealth. My wife is investing in UK stocks shares in an ISA. As we build our wealth and eventually retire, is there a way to work out strategically if we would be financially better off staying in the UK or moving to the US from a currency point of view when we draw money out in 10 or 20 years? Well, good question, Chris. And clearly, you know, we went through the principles in the presentation that kind of help us answer this question, right? I wouldn't necessarily say we want to lock ourselves in to where we live, say in retirement, based upon where we have our investments, right? Because if you're going to live in the UK and you want to retire in the UK, you can certainly build a portfolio that is appropriate for someone in the UK through those US instruments, through those US ETFs. They're dual listed, they're dual qualified as UK reporting funds. The Vanguard ones are. So they're optimal for tax purposes in the UK. They're not PFIC, so they're optimal in the US. And we can get all the UK stock exposure we need. We can get non-US dollar denominated debt that we need. Again, remember, just because those investments appear, say, on your Schwab account, right? You've now got a Schwab account, and because Schwab is reporting in dollars, okay, that's just they're reporting to you in dollars. They could have taken all the values at the end of the day and summed them up and reported them to you in yen. That wouldn't have made it a yen-denominated portfolio. You have to look at the underlying investments. So think about it in that way. And if you're going to stay in the UK, Chris, make sure that that portfolio that you're building at Schwab has a lot of non-US investments in it, right? US instruments, when I say US investments, I'm talking about the underlying stocks. They're not just all US stocks, but they're European stocks, they're German stocks, they're UK stocks, and so on and so forth, because those will be the ones you need to have in your portfolio if you're going to retire in the Eurozone or the in the UK, and you don't want to risk being on the wrong side of the long-term currency trends. All right, I hope that helps. I know it's a very counterintuitive concept we have to work through here. All right, Maureen writes, I am wondering, as a French resident, that investing in VGK or FVZ would expose me to a 30% capital gains rate. Good question, Maureen. Well, if you are a French resident, if you're an American citizen, which I presume you are, the beauty of these funds is that, you know, the U.S.-French double taxation treaty, which we often discuss here at Thun Financial because we have so many clients in France, is great because it exempts U.S. sourced income from French capital gains tax for U.S. citizens. So, so you wouldn't pay 30% on a U.S. sourced investment. You would pay whatever the U.S. tax rate is because you're going to still have to pay U.S. taxes. But unfortunately, VGK doesn't qualify for that because VGK, of course, right? It's not, we call it a New York traded instrument, but all of the underlying investments are European stocks. And so you can't take that, that tax treaty and apply it to VGK. So yes, the capital gains rate that will be applied in France to this investment for you will be whatever the French capital gains rate is for you, right? And that can be quite high once you add in all the various social taxes and so forth, depending upon what your marginal rate is as well. So, but that's no worse or no better than any French investment you would have had the opportunity to invest in as an alternative. And of course, VGK is vastly more efficient for US tax purposes. Now, what I would recommend is if you have some kind of a qualified retirement account, an IRA or 401k, you take the VGK investment, the European stocks, put it in there, because under the US-French double taxation treaty, by putting it in the retirement account, when you eventually sell it and take the cash as a distribution from your US retirement account, the retirement account distribution, whatever the underlying investments were, is a US source income. And so it's excluded from French taxation. And so this is something we're working on with our clients and friends all the time to get the portfolio structured this way so that all of the non-US investment income that would be taxed at French rates is housed in those US retirement accounts, so we can recharacterize it as US sourced and benefit from the lower tax rates accrued from the US-French double taxation treaty. I know that's a mouthful, Maureen, but let's go through that again on a call if we need to go over it. And Maureen writes, by which I meant my US tax declaration. Okay, well, your US tax declaration, you know, there's no 30% capital gains rate in the United States, right? Capital gains rate in the United States are 15% or 23 or 20% or 23.8% currently. So as long as you're not paying state taxes in any state, there's no way to get the U.S. capital gains rate up to 30%. So I'm not quite sure what the 30% rate you're talking about. You may be thinking of, if you've read about U.S. withholding rate, the U.S. withholding rate on dividends and interest can be 30% for people in some countries. It's usually reduced, but that doesn't apply to you because you're a U.S. citizen. That's the rate that's applied for non-residents with U.S. sourced income, and it doesn't apply to capital gains in any case. So a little confused there, Maureen, but give us a call and we'll sort it out. All right. Ellie writes, we are going to leave the U.S. and travel to the U.K. for 1.5 to 3.5 years, and then we will return to the U.S. We have just sold our U.S. house and we are looking to invest the proceeds. We have invested most of the proceeds in U.S. ETFs with U.K. reporting fund status. Great. But we are stuck on what to invest the final portion in to provide stability, safety. We have been advised to invest in TIPS, bond ETFs, but can't find these on the HMRC listing. Do you have suggestions on what to invest in now to provide an element of safety, given that the interest rates may soon rise, and hence bond investments may not be the best? Thanks. Well, great question, Ellie, and you're thinking about this just in the right way. Yes, I mean, bond yields are so low, it means that the rates of return on bonds is likely to be very low. And if bond rates rise, then their market value could decline. So it's a difficult moment to buy bonds, undoubtedly. On the other hand, we need to have some bonds in our portfolio at all times, because you talked about having some stability. If there is a crisis of any type, right, you will want your money invested in secure U.S. government bonds, British government bonds, German government bonds, because these investments will not lose value in a crisis, right? When you may be facing significant losses in your stock portfolio, because the stock market, as we all know, periodically has big corrections, big bear markets, and so in those moments we need to make sure at least some of our money to cover at least 3 or 4 years of expenses is invested in bonds, so that we are not forced into selling stocks at discounted prices. So I absolutely recommend that you have some bonds. TIPS, I think, are a good portion. Should be that's a good investment. I wouldn't put all of my bond allocation in TIPS. I do believe, I have to check on this, but I believe that there's a Vanguard fund, a fund called VTIP, VTIP, that invests in U.S. Inflation adjusted, inflation protected bonds, and that is a reporting fund. So I would look at that. But if you contact us, we can tell you which bond funds are eligible for protection as UK reporting funds. I know that BND is for sure, and I think there are a couple other ones, but I can't remember them off the top of my head. But you're thinking about this correctly. Yes, have some bonds. Make sure if you're taxable in the UK, they are held in a reporting fund in a taxable account, right? If you have IRAs or 401ks, you don't have to worry about that so much, because that IRA will be a wrapper that will, as long as you're not taking distributions, will not it will not tax the underlying investments. Only if you take eventually distributions, you'll have to pay tax rates as if they were regular income. So if you want to just buy a conventional TIP, inflation protected TIP treasury bond, and it's not a reporting fund, just house it in an IRA, and then you're not going to have a UK tax problem. I know that's not totally obvious, but let us know and we can help you with that. Carol writes, some time ago, Charles Schwab stopped letting UK-based US citizens buying ETFs or mutual funds. Now they do not even permit automatic dividend investment on funds already owned. How do Thun Financial avoid this restriction? Yes, thank you for bringing that up, Carol. This is a huge issue. We just had a presentation about a month ago where we went through the whole issue of restrictions and account closures and things like this. And it is true that Charles Schwab and all U.S. advisors, or I should say all U.S. custodians, no longer will allow U.S. funds to be sold directly to investors in the Eurozone, and for the time being, that still includes the UK, so, following these rules. And so you cannot reinvest your dividends, you cannot buy more ETFs, you cannot buy mutual funds. We get around that because and why is this? This is in response to the EU MiFID rules, which came out over a series of years, but really began getting enforced in 2019. So that's the source of the problem. The MiFID rules have an exception for when a portfolio is managed by a non-EU located investment advisor or investment manager. So when we open accounts for our clients at Schwab or Fidelity for that matter in the UK, okay, we are exempt from that restriction. So we can go into our clients' accounts at Schwab and Fidelity where we're appointed as the independent advisor, and we can buy and sell these ETFs for them without restriction. So that's the workaround. That's how it works for us. And I realize it's kind of a bummer that we're able to do stuff that you can't do on your own, but it is what it is. It's the EU rules. All right. Michelle writes, or wiring cash from, I'm sorry. Michelle writes, I don't understand tax implications of wiring money from a US Schwab account to my UK bank account. Could you explain the relevant tax law tax implications? Also, the connection to what you are talking about. I still am confused. Are you this? Yeah, I know it's very confusing, but let's just talk through the tax implications of wiring money from the US to the UK, because that's your most explicit question. Okay. The US and the UK, in a similar way, they don't tax movement of money, right? You can move money from one account to another account in the US, or you can even move money from one account in the US to another account in the UK, or between accounts in the UK. None of that is a taxable event. The UK, like the US, taxes when income arises, right? Now, you may sell something in the US and that may create a tax liability and you have to pay taxes on that, and you may have done that so that you can transfer the money to the UK, but it wasn't the transferring of the money to the UK that created the tax liability, it was the selling of the security and realizing a capital gain, right? Or having the dividend paid to you. Those are taxable events. Sending them the money is not itself taxable in either the US and the UK. Now, there is one exception to that, and that is if you are in the UK and you have made the uncommon election to be taxed on the remittance basis, so you are a remittance-based taxpayer, and then during that remittance period, you bring money into the UK, then yes, that remittance, the bringing money into the UK, is a taxable event for UK purposes. But that's just a caveat for rare circumstances. It probably doesn't apply to you because very few people are on the remittance basis. You would only do it if you're extremely wealthy with a lot of income from outside the UK. So that does not apply to most people. So don't worry about transferring the money to the UK. That's not going to create a tax liability for you, right? What you have to be worried about is the UK taxation of all the transactions that may precede that transfer, where you're selling a security in the US and so forth. And so how does this connect then to the presentation we're talking about here? Well, I mean, in the big picture, right, if you are in the UK and you've had a properly constructed portfolio, the amount of money that you're going to get back is going to be an amount that's going to have sustained its value in purchasing power terms in the British in the British currency, because you had a lot of investments that were going up if the British pound went up and so forth. So that's the connection there. But in terms of the pure taxation issue, transfers between the US and UK are not themselves taxable events. All right, I hope that helps. All right, Nina writes, does PFIC apply to single stock investments in offshore market as well, or is that a concern only for ETFs? Thank you for that question, Nina. Yep, I need to underscore this. Right, a PFIC, a passive foreign investment company, is a fund. Let's call it that. It's called a pooled investment in tax terms, but it's essentially a fund. It's an ETF is a fund, a mutual fund is a fund, so that applies to funds. It does not apply to individual stocks, right? And one of the ways that we talk about when we talk about the PFIC problem, we have a whole presentation on the PFIC problem. One of the ways we say, hey, how do you get around the PFIC problem, right, is to buy individual stocks only, right? And you can do this through a UK broker. So if you're absolutely insistent that you don't want to send your money back to the US, you want to have a brokerage account in the UK, or you want to have a brokerage account in Germany or in Japan, and you don't want to create huge US tax problems for yourself, open up that brokerage account and buy individual stocks only, no funds, right? The funds are going to create big problems for you. But individual stocks, yeah, is a little bit complicated. You got to you got to report them in the other currency and translate all the dividends into US dollars for US tax, but it's not that complicated and it's not punitively taxed. And so that is one of the solutions we talk about when we talk about the PFIC problem in detail in webinars. The problem is it's an inferior solution because it's very difficult to build a well-designed, globally diversified multi-currency portfolio by buying one stock at a time. You'd have to buy hundreds of stocks to get the benefits of diversification. And so we don't recommend that as a strategy, but it is true. Individual stocks are not subject to the PFIC problem. All right, so thank you for bringing that up, Nina. Maureen writes, how can REITs be a good investment with WFH? Wonder what that is, WFH offices closing. Well, I think what you're saying is office towers, or lots of the devastation on the real estate market in many places as a result of COVID. Well, good question, Maureen. I mean, COVID has certainly hurt some parts of the real estate market, but it's actually been very good for other parts of the real estate market, such as the multi-unit and single-unit residential markets in many places. So real estate is more than just office towers in big cities, which have obviously been hurt. It's all kinds of things. It's apartment buildings and it's land in agricultural areas. It's data centers now and cell towers. All these things are packaged into real estate investment trusts. So it's a very diversified portfolio. And if you look at its performance, it was hurt particularly bad during COVID. It's rebounded dramatically now. But in the long run, the key thing is we like real estate investment trusts because they have high returns over the long run, but the returns are not highly correlated to the stock market. So when stocks are doing bad, you can see that REITs are often doing very, very well. And you can go back and look at years where the stock market did poorly, such as 2018, 2001, 2011. These were years where stocks were doing quite poorly. REITs did quite well. So it's a hedge. It's to make sure that we don't have all of our eggs in one basket. And when our stocks are getting hit, we've got other investments that hopefully are doing better. All right, so I hope that helps, Maureen. All right, Lisa writes, let me just scroll down here. If I want to invest a lump sum of money, I'm sorry, say $100,000, would it be best to spread out my total investments over a few months or a year's time span or all at once? Well, that's a good question, Lisa. I mean, look, the reality is stocks and bonds and real estate investment trusts, the value of these investments on average go up most days, right? So the probability, if you're going to simply play the probabilities, the best probable outcome is to just put it all into the market on one day. But, that's a probable outcome. It's not a for sure outcome, right? And so I do recommend when people are coming from cash that they should dollar cost average into the market. So maybe we're going to buy it over 6 weeks in 3 periods. And we'll buy a third of the portfolio tomorrow. We're going to buy a third of it in 2 weeks, and we'll buy another third of it in 4 weeks. That way you get the average price over 3 periods. Limits the risk that, oh my God, I just put all my money in the market. Guess what? Something bad happened and the market drops 5%. Nobody wants that. So it's a little of a psychological way to help mitigate the risk and the fear of having something bad happen right after we put the money in. But it's not good to wait too long, because the longer you wait, the higher the probability that you're going to lose because the markets went up and you were sitting in cash. I hope that helps. All right, Rick writes, do you have a recommendation on a website app to pay attention to in order to track currency conversion rates? Any advantage to one over the other? Well, I have a bunch of different ones that I go to every day. I watch the Wall Street Journals. They have good, succinct reporting on stock and bond and currency markets from around the world, updated in real time if you're a subscriber. Bloomberg's very good. I like Bloomberg. That's a good place. But there are lots of money websites that have currency monitors. So I would just look around. CNBC has a website with a lot of data on it. Morningstar, I don't know if Morningstar has a good currency monitor website, but CNBC does, Wall Street Journal does. Bloomberg's probably the best. They have the best data for most of this stuff available. So that would be my recommendation, Rick. J&R writes, for those of us in small countries, Israel in my case, expenses in shekels, how to diversify given a small economy in a small country, as opposed to the examples of the euro and pound, which are much bigger local economies? Okay, well, that's a great question, right? Very, very good question, J&R. Thank you for bringing it up. Yes, right. I mean, look, if you're living in Costa Rica, right, you can't put 30% of your portfolio in Costa Rican investments. Even if you're living in Israel, right? It's a dynamic economy, but it's a small economy. You can't have a diversified global portfolio where you've got 30 or 40% of your investments in a stock market that constitutes 1% of the global equity allocation, right? So in those cases, what we do is we say, okay, don't focus on building a portfolio of the local asset base, right? I mean, maybe a little bit. You should definitely have some money in shekels and shekel denominated bonds and the local Israeli stock market, but you can't go too big into that. So what you do is, what you want to have is a non-US dollar portfolio. You want to have a portfolio that's invested globally outside of the US, because what you want to do is the dollar is going to appreciate or depreciate against most other currencies. That's why if you look at the euro and the pound, the graphs that we showed, I mean, they're basically losing value simultaneously against the dollar, and you're going to see eventually they're going to gain a value against the dollar as well. So what we want to make sure is that we're not overexposed to the dollar when we're in a small country. We don't want to have all of our money in dollars when the dollar then becomes the weak currency, and now the cost in shekels for everything goes up when we have to measure it in dollars, right? So my advice is in cases like that, don't focus so much on building the local currency portfolio, but building a global non-US dollar portfolio to hedge against a weak dollar future. All right. Maureen writes, we prefer to refer to ourselves as global nomads, not global vagabonds. Oh, okay, good point. I should have changed this. Global nomads. Thank you very much, Maureen. I got to change that for the next time. Yes, nomads has become the popular and the more appropriate term. I agree. Thank you for pointing that out. All right, Penelope writes, slide 28. How does currency affect bonds? Okay, well, okay, good question. Okay, I didn't want to spend a lot of time on this, but when I say that stocks don't have a currency denomination, that's true. A share of, as we saw in the presentation, a share of GlaxoSmithKline is a share of GlaxoSmithKline. It doesn't matter if it's dollars or yen or euro or whatever you measure its return in or whatever you paid for it. You want to share GlaxoSmithKline. That's not true when you buy bonds. Bonds do have a currency denomination. When you buy a U.S. Treasury, right, it has a fixed rate of return. Its coupon and its price tells you its rate of return over a specific period of time. And at the end of that period, they're going to give you your money back in dollars, right? And the British government bonds are going to give you the return in British pounds, and the German bunds in euros, and so on and so forth. So bonds do have a currency denomination. It's not true of stocks. Their returns will not adjust, right, to make up for that. We kept seeing in the examples of the stock investments, either the stock ETFs or the individual stocks that I showed, that the price adjusted to offset whatever the change in the currency was, so you ended up with the same thing in any case. Bonds don't work that way. They will not adjust, right? You're going to get that same amount back, whatever happens to the currency. And so you have to be more careful there. And the key thing is then, if you're living outside the United States and you're paying for your expenses in euros or pounds or yen, you should have some of the bond portfolio denominated in bonds of that country's currency, where you're going to have to pay for those ultimate liabilities, those life liabilities, right? And so, Penelope, if you're in, I'm not sure where you are, but if you're in the Eurozone, right, the way we do that for you is by putting non-US dollar bonds, a lot of Euro bonds into your portfolio. We do it for clients. We still use a US ETF, right? And that ETF trades in US dollars, and people say, oh, well, that's a dollar denominated investment. No, it's not. You're just saying what its value is. All of the underlying investments are non-US dollar investments. And so therefore the value of the fund, even if it's traded in dollars, is going up or going down in relationship to the bond fund of the currency of the bond fund itself. All right, I hope that helps. I know it's very hard to get your head around this. It's a non-intuitive concept, but you have to figure it out, or you're not going to have the right exposures in your portfolio if you're an American abroad. All right, Gopal writes, is the U.S. government likely to switch to residency-based taxation anytime in the near future? Great question, Gopal. God, you know, I've been watching this. We've been working, Thun Financial has been a big supporter, and I've been involved in the ACA, the American Citizens Abroad, for many, many years. They have done a great job working very hard to lobby Congress to get rid of this onerous citizenship-based taxation system. They've been very close in a couple of cases, at a couple points over the last couple of years. I know the people at the ACA now think that they have another golden moment, but I'm not holding my breath. I don't think the prospects for it politically in the United States are very high, that you're going to see that this system is put to bed through a change in law. All right, sure, I can't give you a better, more optimistic outlook there. All right, Rudolph writes, is the IRS reporting limit for owning, is there an IRS reporting limit for owning a PFIC? In other words, for example, if we have less than $25,000, must we report those PFICs and pay the tax on the gain, or just report it, or none of the above? Okay, Rudolph, good question here. Yes, there is a limit here. I think it's $20,000 or $25,000. If all of your PFIC investments globally are less than the threshold, say $25,000, then you don't have to report the PFICs on Form 8621. You still have to report them as investments, right, as mutual funds, but you don't have to report them as PFICs. But as my colleague Roger Healy, who is one of our resident tax experts, point out, the problem with that is that if you own these and then the value of them exceeds that $25,000 threshold, the problem is the only way to now have reported them properly when you do have the reporting obligation is if you had reported them over the whole period up till then, right? So you know, if you've got a relatively small amount of PFICs and they never exceed $25,000, I would recommend you get out of them, and it's not going to be a big problem. But holding them and think I'll deal with this once they exceed $25,000. Well, the moment they exceed $25,000 in total value, you now have a problem that goes back from the start of the holding period. So yes, that limit is there, but don't let it trick you into thinking you're getting a gift from the IRS that you're not. All right, I hope that helps. Robert writes, I'm an American living in Switzerland and don't plan to leave. Okay, I have my portfolio completely invested in the U.S. Should I be buying Swiss stocks to diversify? Switzerland is a very small, $8 million population, so most of the revenue in Switzerland's companies comes from outside Switzerland, where the Swiss franc is always where the Swiss franc always is stronger. Advice? Okay, that's a great question, Robert. And Switzerland is a great example, right? You know, it gives a lot of good examples. Let's just talk about this fact that you point out that Swiss companies typically get all of their money from outside of the country. So let's take a company like Nestle, right? A lot of times we think, oh, well, we want to buy a share of Nestle because it's a nice Swiss company. But, you know, does that make it a Swiss currency denominated investment? Well, not really. I mean, because Nestle gets something like 92% of its revenue from outside of Switzerland, right? And so where does it get all of its revenue from? It gets a lot of it from North America. It gets tons of sales in US dollars, in euros. It's big in Japan where it makes lots of money in yen. So that company itself is like a diversified portfolio of multi-currency investments, right? The least of which is the Swiss franc. So this is another case where it really lays clear that just because a stock happens to be in the UK doesn't mean it's a UK necessarily UK. It may be, right? If all of its sales are in the UK, well, then it's going to probably vary quite dramatically with the strength and weakness of the British pound. So we have to analyze this now and really think through the real currency exposures within our portfolio, right? And it's just like the big U.S. Tech companies, right? They get most, you know, the S&P 500, the big collection of U.S. large global multinational companies, right, generates more than 50% of their revenue from outside of the United States. So are they really US dollar investments? You know, kind of, but not completely for sure. And so we have to think that through in terms of the impact on our assets and liability balance sheet that we talked about. But Switzerland is another case, right, where one of the things you have to think about, and this could be applicable for a lot of places, right? You're right, you know, Switzerland's a relatively small economy. It's hard to invest in the Swiss stock market. You should do it to some extent, but even if you do with a lot of multinationals there, it may not be an indicator of the underlying performance of the Swiss economy and hence the local cost of living. And so how do you hedge against this? Well, one of the things people we have lots of clients in Switzerland, and many of them have very large Swiss real estate holdings, right? Real estate's very expensive, and people who live there for a long time end up owning a lot of very valuable real estate. That's a very high percentage of their net worth. Well, real estate is a very local investment, and real estate typically tends to vary in quite direct relationship to the value of the underlying currency. So if the Swiss franc is always a strong currency, it's unlikely that measured in any other currency that your Swiss real estate is likely to lose much value. So it's a very stable investment that's likely to do well in relationship to the Swiss franc. So that's one way to diversify, right? It's not just about stocks and bonds. It can be other forms. If you have a job, right? If you have a Swiss franc pillar 1 or pillar 2 investment, especially the Swiss franc pillar 1, we often say to people, you know, because a lot of people will build up huge amounts of money in the Swiss pillar 1 pension system. that will pay out a Swiss franc annuity for 30 or 40 years in retirement in a very large amount of money. Well, if you've got that, right, you already have huge exposure to the Swiss franc because you're going to get all that a Swiss Pillar 1 paid to you in Swiss francs. So you probably don't need to further expose yourself to the Swiss franc because you've already got a lot of exposure. You've already got a lot of investment that's going to vary with the cost of living where you live. So I think that's the way you got to frame it and think about it, looking at the real underlying exposures, not just of your investment portfolio, but other types of assets you have, your pensions, your real estate, so on and so forth. I hope that helps, Robert. All right, Jason writes, I live and work in the UK and I am paid in British pounds. If I were to add a US-based stock portfolio and share portfolio monthly, does that change anything? Well, Jason, yeah, I mean, I guess what is the alternative, right? If you start sending money to the US and investing in stocks, the question, well, are you going to invest as we've shown you can do in UK stocks, but do it through the US? Or are you going to start investing in US stocks and emerging market stocks and German stocks, in which case you're building a global portfolio? What I wouldn't do, especially since you're in the UK and you're you have your job is tied to the British pound, your salary is denominated in the British pound, I wouldn't only buy British pound real estate or British stocks, right? Because now you're overexposed to the British pound, right? You want to diversify. So a good way, yes, to do that is send some of the money back, start investing not just in US stocks, but in a global portfolio. And a global portfolio would include a lot of US stocks. So I think that is the way to go, exactly as you suggest, but don't overly focus on US stocks. Buy the Vanguard ETF that invests in Europe, the Vanguard ETF that invests in emerging markets. All of these are ways to diversify globally. All right, Michael writes, thank you for the informative presentations. My concerns relate less to stock investment choices and more directly towards the fluctuating value of cash on deposit in currencies. I just relocated abroad permanently, but the bulk of my assets are in US dollars and will remain that way. But I now have daily living expenses in a foreign currency, and the daily fluctuation of the dollar causes my foreign costs to fluctuate accordingly. I am trying to mitigate the more today, less tomorrow currency exchange differentials I am experiencing, and I am looking for currency hedges or futures or something to prevent me from having to exchange at lows and highs just to pay my foreign bills. Okay, right, good question here. But I'm going to ask you, Michael, to radically reframe how you're doing this, right? Let me take a couple of statements here. You said, I just relocated abroad permanently. The bulk of my assets are in US dollars. When you say US dollars, do you mean cash, right? Because cash and bonds have a currency denomination. So I'm wondering, do you really own only cash, US dollar cash in a bank deposit and maybe some bonds? US dollar denominated bonds, or do you mean your investments are back in the US and they're at Schwab or Fidelity or Vanguard or Morgan Stanley or wherever, and at the end of the day they show me the statement of its value in US dollars? Well, that doesn't mean that you necessarily have your investments in US dollars, because all of those underlying investments could be stocks from all around the world, could be bonds from non-US dollar bonds from all around the world, that they're just showing you their value at the end of the day in the equivalent of US dollars, because all those companies report to their clients in US dollars. It doesn't necessarily mean you're invested in US dollars, probably not, right? And in any case, you shouldn't be, right? And you can have your accounts in the US and you can build that multi-currency global portfolio, which will then fluctuate less only in relationship to the dollar and probably more in relationship to wherever you are. You just said that you've moved abroad permanently. But I'm not sure where. So you want to make sure that even if you're investing through the US, your portfolio has a lot of non-US investments in it, right? And then if you do that, guess what you'll see? On the days that the dollar is weak, you're thinking, oh my God, the dollar's weak. You know, it just got more expensive for me to live here in wherever I am. But guess what? Your portfolio will have gone up. It will have adjusted for that because its return as stated in dollars will be more than it would have been otherwise, right? Because all those underlying investments are worth more now because their non-US dollar investments, their European stocks, their Japanese stock, whatever they are. That's the way to hedge yourself. Okay, all this stuff of hedging with currencies and futures, forget it. Terrible outcome, right? Hugely tax inefficient. And furthermore, all you're doing is speculating on the relative change in the value of currencies over short-term periods. You need to be hedging over the long run by holding a multi-currency portfolio. That is the way to reduce your risk, okay? Sitting around and speculating what's going to happen to the dollar versus the euro over the next 6 months, big mistake. That is a terrible investment strategy. All right, I hope that helps, Michael. Matt writes, I'm a dual US UK citizen. Most of my wealth sits with my US based company as net profit. Can a UK based company convert euros to dollars for investing? Well, they certainly can. It has potentially complex local and US tax implications. So we have to really talk about that. But sure, we open accounts for companies all the time and build portfolios for them. Sometimes their goal is a little bit different in terms of what they want to be investing in when they're managing the company's cash versus the personal cash. But yeah, we can do that. All right. Rachel writes, what is the most beneficial way to open IRS compliant investment account outside of the US? When trying to open a Roth IRA account at Schwab, the customer service agent warned that the IRS would penalize you if they do an audit if you invest with foreign earned income. The only kind of income I have, US citizens and Netherlands residents, taxpayers, both. Is this accurate? And is it different from other investment accounts, e.g. investing in stocks unrelated to retirement? I have no retirement account until now, and I'm trying to build my wealth, but want to do it in a legal manner, of course. Okay, Rachel, great question. We do have other presentations that dig into this more in greater detail, but what we hear a lot is these are a lot of complex rules here, right? And I can tell you that it is absolutely not illegal for you as an American living outside the United States to open an IRA account, even a Roth IRA account, and even potentially fund it with foreign earned income, right? That, under the right circumstances, is not illegal, or well, it's definitely not illegal. It may, if you don't do it the right way, it may fall outside of the rules, right? So there are a lot of complex rules that it works, it doesn't work, right, because of this circumstance. So let me give you the most common example. I don't know specifically what the Schwab representative was referring to, but remember, when you're talking to a Schwab representative on the phone, especially when we're talking about complex cross-border taxation, right? These people are not trained in understanding this. They've heard something, they've been told, tell the people it's illegal, don't contribute to your IRA fund. It's a very, very, very general statement that is potentially true in some circumstances, but not the others. So the most common scenario where, as an American abroad, the most common reason why you do not want to be contributing to an IRA is if, this is one of the reasons, not the only reason, is if you are earning foreign earned income and you are taking the foreign earned income exclusion on your US tax return, right, which allows us to eliminate the first $105,000 or $106,000, I think $109,000 now, $109,000 of taxation. Okay, if you do that and you use that to eliminate US taxation on all of your earned income, your salary, right, you no longer are eligible to contribute to an IRA because you have to have non-excluded earned income. It can be foreign earned income, but it can't have been excluded using the foreign earned income. If it was, then you're not eligible to contribute, right? And there could be other reasons. If you're married filing singly, you can't contribute under most circumstances, even if you have income that's not excluded. Okay, so there's all kinds of little gotcha rules that where it works, oh, it doesn't work, right? And so you have to be very, very careful. I mean, we work very closely with our clients to understand their situation and then determine whether or not it makes sense to contribute to an IRA while you're outside the United States. And now we're just talking about the US rules, but hold on, you're in the Netherlands, so you're taxable in the Netherlands. And I can tell you, if you're in the, aside from all the US rules, right, the Netherlands does not treat US Roth accounts well. So if you're in the Netherlands, even if you're eligible to make a contribution to a US Roth, don't do it if you're also taxable in the Netherlands. So that's a whole nother can of worms we can get into, but give us a call and we can explain it to you. All right, Maureen says, excellent, thank you. I'm glad that helped, Maureen. Myra writes, we are dual US Canadian family and our dual citizen daughter living in Canada is investing in ETFs in Canadian dollars. Can she avoid the tax issue by using a tax deferred account IRA equivalent RRSP? Does your advice to only use US compliant companies in a US dollar account apply to tax deferred? She's 25 years of age. Okay, if she's in Canada, okay, I mean the biggest problem with what you first said, she's in Canada, so she's Canadian taxable, but she's investing in Canadian ETFs. Well, those are PFICs. All right, so you just did what we talked about throughout the presentation of the big mistake. But hold on, there's a way to redeem yourself here. If she's doing this within an IRA account, no problem, because the IRA, right, is the structure itself is taxed, and it's taxed in a way that's covered by a treaty, so you don't have to worry about the PFIC reporting problem if you're making these investments within a US IRA. And also, if you got an RRSP, that RRSP is also qualified by the treaty. So again, the distributions ultimately from the IRA, the RRSP will be taxed, but the underlying investments are never taxed. And so even if they're PFICs, right, it doesn't matter because you don't tax the PFICs or you don't tax the mutual funds or the ETFs or whatever you've got in your retirement account. You only tax the distributions, and the distributions are taxed as regular income. They're not taxed based upon the nature of the underlying investments. So Myra, as long as your daughter is doing this either in a US IRA or a Canadian RRSP, no problem. All right, Aiko writes, for a US person living in the UK married to a non-US person who can invest without PFIC tax issues, would you still recommend converting GBP to US dollar and investing in the US using UK reporting funds, lower fees than the UK? Okay, if so, what's the best way to figure out what percentage to invest where, or does it matter at all? Okay, great question, Aiko. And I think you're onto something, right? I mean, we're talking about the imperative here of using US funds because otherwise you create a big US tax problem for yourself. But as you point out, your wife, if she's not a US taxable person, she doesn't worry about PFIC reporting. It doesn't apply to her. She's not a US tax person. There are no PFIC rules in the UK. There are reporting fund rules, right? And she does have to pay attention to those, but you're right. I mean, she may very well, you may very well want, and many of our clients, we'll have lots of clients who are US citizens married to non-US citizens, lots of UK citizens among our clientele, but we still invest for them because yes, we can open up accounts, we can buy US ETFs, we make sure that they're the reporting funds, and they work just as well for people who are not US taxable as they do for people who are US taxable. Now, that works in the UK because the US has an estate tax treaty and there's a separate can of worms with respect to US estate tax when a non-resident alien of the United States buys US ETFs or other US situs assets. But it's okay in the UK because the UK and the US have an estate tax treaty that mitigates that problem. Don't do it in, say, Spain or the Middle East or Latin America with your non-resident alien spouse because those countries don't have estate tax treaties. It doesn't work. But I think for you, Aiko, in the UK, you're building your portfolio. In the US using non-PFIC reporting funds, you can do it just as well for your wife. How much you should put in different ones? Well, we talk about that all day, you know, asset allocation, right? How much in US stocks, how much in UK stocks, how much in European stocks, bonds, real estate investment trusts. You know, that's a function of a very detailed planning process we go through. But, you know, I mean, diversification is the key, right? The simple thing is have a little bit of all of these investments from all of these parts of the world, especially if you're a global nomad, not a global vagabond, but a global nomad. All right. I hope that helps. All right, Barry writes, okay, I'm gonna scroll up here. Sorry. Okay, Barry writes, what is the best way to sell UK shares listed on the UK exchange if you are resident in the USA and hold paper certificates? Oh, I can't find a UK broker that will trade for non-UK residents. Yeah, That's a good question. This is a very rare circumstance. It comes up. I think the best thing you should try, Barry, is go to yeah. So you've got to redeem certificates to get shares. I mean, you're going to have to try to get this done at a UK broker and just get the shares on deposit in the UK. And if they don't want to, yeah, it's a tough problem. You can try some US, but look, there's plenty of US brokers that have the capability to take your UK certificate and convert it to a UK share. Whether or not they'll do it is another thing. And it is complex. I mean, sometimes we have people who own shares in an account from the UK and they want to sell them through a US broker. They want to transfer them to the US broker and sell them. That can be done. It's not common. We don't do it a lot, but it can be done. We've done it. When you have share certificates, yes, it's a big problem. I don't have a good answer there for you, Barry. Call a lot of brokers until you find one that will do it for you. They can do it. They just don't want to do it because it's a heck of a lot of paperwork and it's a heck of a lot of non-standard procedures. So you can imagine why they don't want to take on the business. All right, good luck with that. Eric writes, presumably WFH, well, working from home, of course, working from home, yes, okay. Working from home, yes, okay, well, I thank you very much for clarifying that, Eric and Maureen, and working from home, WFH, yes, so, but I addressed that though, nobody's going to the office, so thank you for that clarification. Ellie writes, thank you, the same person heading to the UK for a few years. If I understand, if we get a non-UK reporting TIPS bond ETF and house it inside a traditional IRA before we leave the US, we should be safe from UK taxation. Yes. Simple answer, yes. Okay, good. We have already invested $6,000 each in our Roth IRAs for 2021. Does this prevent us from investing money in a traditional IRA in 2021? Yes, right? The limits for investing in Roths are cumulative across all IRAs, whether they're Roth IRAs or traditional IRAs. So if you've already maxed out your Roth contributions, you have no amount that you can contribute in the same year to a traditional IRA. They are not separate limits, they are just IRA limits. All right, and actually the Roth has its own separate limits too, but you're probably okay there. All right, Elba writes, I live in Chile and looking to diversify my US investments without exposing myself to Chilean tax liability. Having struggled with contradicting benefits in the US and Chile, which could potentially result in double taxation. Most of the comments have been focused on Europe and wondering what you recommend, what your recommendations are for expats living in South America. Well, we have tons of clients all over Latin America, including Chile. And look, I mean, at the end of the day, you have to factor in both the US and the Chilean tax ramifications of your investment portfolio. But if you're an American citizen, you got to get square with the U.S. government. You got to not be holding PFICs. We have to work this out to make sure it's also not creating problems for you in Chile. But we can't really do that unless we are talking to you and getting a really detailed understanding of your tax situation in Chile, Alba. So I would recommend you give us a call and we can start sorting it out for you. But there's no way with that very high level I can give you a lot of concrete advice as to how to do it best. But it probably will involve opening accounts in the U.S. and investing through U.S. accounts in the way we've described here. All right, Noga writes, what is the best way to transfer currency internationally? Are the conversion businesses online better than using a bank? Yeah, well, okay, great question, Noga, right? We use, most of our clients, we own accounts, we open accounts for our clients at Fidelity or Schwab, mostly for our clients abroad. We've negotiated very good rates with those firms so that our clients get really good exchange rates. They don't get ripped off, right? Maybe the rate that the client gets is a third of 1% less than the wholesale rate. We've seen people go to their local, community credit union someplace in the United States, and they're charging them 2.5%, and they say, oh, we don't charge you for that, but they're getting an exchange rate. The euro's trading at 118 to the dollar, and they buy euros and they're charged 123 to the dollar, right? $123 to the euro, and so they're totally getting ripped off on the exchange rate. So you have to shop around. you know, a lot of our clients use Wise. Wise has become kind of the go-to for a lot of people. They have good rates. Schwab and Fidelity, if you're working with us, are very good, but be very careful here. You know, even some of the big banks like Bank of America and JP Morgan, we've seen take really egregious, what we call spreads, or giving bad exchange rates. So you have to shop around. And it's particularly bad in Europe if you're using any European bank. All right, J and R writes, speaking of currency, what is the best way to send dollars overseas at the best rates most securely? Well, I think I just answered that question. J and R, try Wise is good. Use some of the banks like Schwab and Fidelity are quite good, but shop around and compare exchange rates. That's where the banks will rip you off. Not by charging you the $50 exchange fee or this or that. That's pennies on the dollar. Where they take you on moving $10,000 or $100,000 is on the actual exchange rate that they give you. All right. Catherine writes, how do I know when it is time to come to a firm such as Thun? Certainly life events, marriage, non-U.S. citizens, kids. Currently investing in somewhat diversified global portfolio of ETFs, VTI, VGK, VTUS, and some bond ETFs using a U.S. address. What is the additional value I get with Thun versus continuing to go solo and long-term investment planning? I'm always getting warned by others on fees charged by firms that will put a dent in your potential earnings. Money that would have been reinvested adds up over time. Thanks for your very helpful webinar. Well, that's a great question, Catherine. And you're right. You have to be fee conscious in investing and paying those transaction costs if you're paying them, and paying VAT in Europe, and paying for custody fees for firms that charge separately for custody. All those things add up, including the management fees charged by investors, by investment advisors. At Thun Financial Creative Planning, we have eliminated virtually all of those fees, except of course for our management fee. We take that, right? And we have to be paid for our services. And what I would say is, Catherine, you're investing in a lot of good ETFs that are dual qualified in the US and the UK. If you didn't say you're in the UK, but wherever you are, and I say, look, I do believe that there are a certain group of people out there, a certain segment of the investor class that can do this effectively themselves and don't have to pay a fee to a firm, even a really good firm like ours, to do it for them, right? Because here's how it works for them. First of all, first and foremost, they intrinsically have to be interested in it. Like if the worst thing in your day is having to deal with your checkbook and your investment account and going online and researching ETFs, and because you hate that stuff, right? You will make big mistakes. And one of the biggest mistakes you'll make is you won't make decisions at all. And then you'll be sitting in cash when the market's going up. You'll have bought the wrong ETF. You bought the ETF that was, oh, it's got a 1.5% fee instead of a 0.1% fee, right? Because you didn't research it well enough. Okay, so that's always a big problem. You know, the other big problem is people are busy, right? You got kids, you got jobs, you got life, right? And even though you're kind of interested in it, you kind of like it, you just, you know, at the end of the day, you know, you keep saying you're going to get to it, you're going to get to it, but now months, sometimes years has passed by, and that session where you were going to sit down and figure it all out just hasn't happened, right? You've been meaning to do it, but life is busy, and so in the meantime, mistakes are being made, being compounded. You're still in that PFIC. You're sitting in cash while the market's going up. Again, these are the big mistakes that happen when you're not working with a good advisor like us, because we will be there. We will be there getting this stuff done, poking you, reminding you, hey, we need your signature on this because we need to do these trades. Our trading team will be investing the cash on a regular basis. And the third thing I'll say is the other big area where we add a tremendous amount of value, aside from we understand all the rules and the tax, we get this stuff right? We avoid the big mistakes, which can be themselves hugely costful. We provide the discipline, right? Because when we are trying to manage our own money, and even if we're the most sophisticated investors and we know all the rules, when it comes to managing our own money, we are trapped by the psychological games that the emotion plays, right? And how does this play out? Oh my God, I panicked and I sold all my money at the bottom or close to the bottom in March or April of May of last year because I thought COVID was going to destroy the world. We weren't selling stocks, we were buying stocks for our clients, right? Because did we know? It was because there was going to be a huge rebound really quickly? No, but we knew in the long run it was the right thing, that this is the pattern. We see something happens, market sell off, we buy, and we had the discipline, we had the separation, because it wasn't our own money. We were doing this on behalf of our clients. We had the discipline to go in and at the height of the crisis be selling bonds and buying stocks. It was a huge home run, right? And I can't tell you how many client relationships we cemented, I know, during that period, because they saw, oh my God, I thought David and his team were making a huge disaster. But in fact, it turned out to be a huge home run. Those people will never not continue using us because they saw the value, right? Their inclination was to sell in the crisis because they were panicking. It was their money on the line, their lives on the line. We said, no, let's be disciplined. Let's apply the good investment principles. In the long run, these assets are going to go up. Let's buy them now while they're cheap. So if you're good at all this, you've got the time, you've got the discipline, right? You have the knowledge, you like it, you've got all that, manage it yourself, you'll probably be okay. If you're missing any or all of those, for sure, you'll need us, and we will make up our fees many, many times over for you on a compounding basis over time. I hope that helps, Catherine. That's my best answer. And I think it's really true. All right, Melissa writes, I'm joining the webinar a little late. My question has to do with things to consider regarding currency exchange rates. All right, between the Netherlands and the US prior to a money transfer for investment to the US. Okay, Melissa, well, I would go back and, okay, if you're thinking about, oh my God, do I have to sit around and wait for the euro to strengthen a little bit more before I send my money back to the US and invest it? Well, just watch the earlier examples in the presentation from the webinar. You can watch it on replay because we addressed that very issue. We're talking, especially the example of the Brexit. We use Brexit as an example where, oh my God, I don't want to sell, I don't want to send my money. The pound is so weak now. You might be saying that to yourself now about the euro. You're in the Netherlands, like, oh, I don't want to send my money to dollars now because the euro's been weak and it was higher a couple of weeks ago, and I'm going to wait for it to get back to there. No, get out of that. You're thinking about currencies. Currencies are a terrible investment. You need to get your money invested in the stocks and bonds market and the commodities and the gold. And if you're sitting around wondering whether or not the euro is going to strengthen or the dollar is going to weaken or whatever, you're playing the wrong game. You're playing the losing game of currency speculation. All currencies lose value. Get out of them, get invested in a portfolio. Do it if you're an American through US accounts, and it doesn't matter if you buy it, if you send it today or send it tomorrow. Once you get into that portfolio, you're going to be on the right track. All right, Myra writes, to move non-US to US company, can a US resident to move non-US to US company, can a non-US resident who is a US citizen open a US non-PFIC account? Yes, Myra, they certainly can. We do it for our clients all the time. It's difficult, right? Because a lot of US firms now will not open accounts for non-residents of the United States. But we can certainly do it for you. So if you're having a problem there, give us a call. All right, J&R writes, most of my investments are in Roth IRAs and traditional 401ks, very little regular money, okay? Would your advice change given the little regular money? I am a semi-retired overseas with a decent dollar pension. Right, well, J&R, I think you're in Israel, right? So the whole kind of matching assets and liabilities, right, doesn't change just because your portfolio investments are held through US retirement accounts. It does make it easier, right? Because you don't have to worry about things like PFICs. Well, I mean, if you got a US retirement account, you're not going to be able to buy a non-US investment in any case. But if you did, you're not going to have to worry about that. You're not going to have to worry about the local tax implications as much because Israel will tax the distributions. They won't tax the underlying investments. So those kinds of things are made easier when the investments are held within an IRA, or 401k. But when you think about the variation and the variability in the value of the investments over time relative to the shekel, right? All the same principles apply. And you want to make sure that if you're spending the rest of your life in Israel and all of your expenses are going to be denominated in shekels, don't have all of your investments in a portfolio that varies very, very closely with the US dollar, right? You want to have an anti-dollar portfolio, one portfolio that is going to do well if the dollar loses value over time. right? And so lots of non-US assets, lots of non-US fixed income, and that's the way to go. I hope that helps. All right, Josephine writes, I live in Bermuda, okay, and have an employer pension. Wow, Bermuda, I wish I lived in Bermuda. I have an employer pension. Can I convert that to a traditional IRA upon retirement? No, you can't. The US does not allow for the transfer into a US pension, an IRA, 401k, Roth IRA, anything like that from a foreign pension ever. Just no, can't do it, and don't do it. You're going to create huge US tax problems for yourself. All right, Josephine, I hope that helps. Elba writes, the majority of my wealth has been accumulated in Chile, foreign earned income, and I'm married to a non-resident alien of the US. Well, you may have accumulated your wealth in Chile, but it's all, if you're a US citizen, it's all taxable in the US. So you better make sure that the way you're investing it is not creating big unforeseen US tax problems for yourself. And I know that seems counterintuitive if you've lived your life in Chile and you don't have a lot to do with the US, but be careful because it will come back to haunt you in a really, really big way. If you get a letter from the IRS and they say, oh, we see that you have these investment accounts in Chile, but we don't see any Form 8621. Where are you reporting your PFICs? Where are you reporting your foreign trusts? Now you are in US tax hell, right? And you have to get that cleaned up. And the way to get it cleaned up if you have a problem with the IRS, because you haven't been compliant, is to go to them first. And then it's relatively painless, right? But if they come to you, all the painless ways to get this sorted out and straightened up for the future are gone, and now you're going to be in IRS hell. So that's my warning, Elba. Be careful. All right. Oh, you're right. No PFICs. Well, okay, but you know, oftentimes pension accounts in Chile can be foreign trust. So there's lots of things here. And Chile does not have a tax treaty with the U.S., so that makes all the potential pitfalls more common. All right. Melissa writes, I want to invest in the States. How could the present unrest in Afghanistan affect any investments at this time? Keeping in mind that I am considering transferring funds from the Netherlands to the US in the coming weeks. Well, you know, global politics is always a factor in stock market outcomes, right? As tragic as the events in Afghanistan are, I don't think it really has any economic impact that's going to impact the US investment scenarios or global investment scenarios. So Melissa, I wouldn't let the headlines, as horrible as they are coming out of Afghanistan, to in any way affect any investment decision that you might be considering. All right. Rachel writes, and we're getting close to the end here. So thank you all for bearing with us. We're going to go through just a couple more questions. Rachel writes, thank you very much. Just a follow-up question to confirm I understood. I, U.S. citizen, Dutch resident, am able to buy U.S. investments in a normal brokerage account, specifically ETFs, index funds, bonds, with a foreign earned income if the foreign tax credit is applied rather than the foreign earned income. This is possible as an individual investor without additional management advisor fees while remaining IRS compliant. Well, not quite, Rachel. Those were the rules for buying these for contributing to an IRA, in which case you're then going to be buying these investments. If you're just talking about buying these things, it doesn't have anything to do with the foreign earned income exclusion. You're scratching the surface and you're getting a little bit of the right rules, but mixed in with wrong interpretation, because this is complex and what you're going through is very, very common. This is unfortunately why a lot of people just throw up their hands. So I don't know what else to say, Rachel, other than I would, you know, unless you're sure you really, really understand the rules and the investment decisions that you make are fully informed by the US and the Dutch tax rules, right? You got to think about working with a firm like ours, because otherwise you're going to create big mistakes that are going to blow up on you. And I understand you may not have enough money to work with a firm like ours, but call us up or email us and we can talk about it, and I can give you some hints or some guidance to do it yourself through a firm like Schwab. All right, hope that helps. Eric writes, what do you think about investing in cryptocurrencies? Oh, I'm glad somebody asked about cryptocurrencies. It feels speculative, much like gold. Best to do in a Roth IRA, so capital gains free. Well, yeah, I mean, look, Eric, I've not been a big crypto fan. Creative planning does not recommend it. I tend to agree with that, but I mean, we'll see. The jury's out on cryptocurrencies. Are they going to become a real thing? They don't stand the test of time. They don't stand a lot of other tests. On the other hand, they've been massively good investments, right? So, and a lot of people believe they will stand the test of time. So, for a little bit of your money, why not? In an IRA, well, problem with an IRA, putting in an IRA is that generally, a little bit of your IRA money in crypto, again, why not? But generally, you want to be somewhat careful with the investments you make in that IRA because you're limited on how much money you can get in there. It has value in terms of tax strategy and so forth. So you don't want to put all your money into something that could blow up and drive your IRA to zero. So those are the trade-offs. All right, Melissa, last question. Thank you, Melissa, for the last question. What can you tell me about Revolut, the e-money institution fintech for transferring funds? It works similarly to Wise for transferring funds. I don't know a lot about Revolut. I have heard of it, but I'd have to do some more research, so I don't really know. I'm not ready to endorse it, Melissa. But all right, well, thank you everyone for all those great questions. Don't forget, we're going to have another webinar coming up on September 14th. Where Kathleen Kaffer and Jake Mongler are going to be talking about IRAs and Roth IRAs and all of the complexities that have been touched on here with investing and building wealth in IRAs and Roth IRAs when you are an American abroad. And so we will look forward to seeing you there. Oh, got one more question coming in from June, who says, thank you for offering this helpful webinar. Educating your clients is very much appreciated. Thank you, June. Great to have you on the webinar. Hope we'll see you at the next one. Thank you, everybody else. Hope you found this available, helpful. And don't forget, it is now available in a couple of hours as replay. We'll send out a link to you. Please feel free to share it with friends and anybody else who you think might find it helpful. That's all for now. Thank you very much for attending.